If the United States doesn't press its advantage, other nations will. And other nations are. And those nations might be ones who do not see the world the way that we do, and who choose to build a different future that is much more damaging to our values than an American Bitcoin industry ever could be. Welcome to Galaxy Brains.
An infinite amount of cash.
I'm your host, Alex Thorn.
The U.S. banking system is sound and resilient.
Bitcoin made a new all-time high.
If you're not long, you're short.
Satoshi's going to come on there, laugh hysterically, go quiet, all Bitcoin's going to be erased.
Bitcoin's the best crypto asset.
Bitcoin is going to zero.
Welcome to Galaxy Brains. I'm your host, Alex Thorn, head of firm-wide research at Galaxy. Bitcoin not zero, and we're back for another great episode. Hey, that clip at the front of the episode is from my speech a few weeks ago at the Bitcoin Policy Institute Summit at the National Press Club. Stay tuned to the end of the pod to hear the entirety of that speech. It's 10 minutes long. And we have a great episode for you today. Austin Campbell, professor at Columbia Business School, former portfolio manager of BUSD at Paxos, and stablecoin expert and regulatory expert. He joins us. He is a repeat guest. We're going to get into it with him about the state of regulation and stablecoins in the U.S. And, of course, we'll check with our good friend Bimet, a BB from Galaxy Trading, as always, to talk markets. Before we get to that, I need to remind you to please refer to the link to the disclaimer in the podcast notes, and note that none of the information in this podcast constitutes investment advice or an offer, recommendation, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. Oh, man. Well, look, we are back. It was like we were in the 50,000s last week with Bitcoin. Now we're up over 60K again. So it's something like 107 days in Bitcoin history. We've traded over 60K, more than 2% now of Bitcoin's life. So that, feels a little more constructive, right, Phineas?
Positive news. Positive news.
You can't be unhappy when the price goes up. I mean, it's...
Look, I learned a long time ago to just try to have zero emotion towards any of it. It's not possible.
We started this podcast, I think, in 2021 or 2? Was it 2 even? I guess it was 2.
It was 2, but early 2.
Yeah, early 2, and so we wrote it pretty far down. Got all the way down to 16.5.
I remember the
start of last year.
Yeah.
We were doing pods.
Yep. Oh yeah, we were doing pods. We were
oh man,
talking long term. Well, I wanted to say I was able to listen to your what sounds like a stump speech for a presidential campaign, but
vote Alex.
We ran a clip at the beginning of the episode. We're going to run the full clip at the end of the episode. I would encourage people to stay tuned for that. It's got a lot of great stuff in there. It's also very Alex. It's very he was just saying that he's
living my best life.
He's got a little Obama in him, he thinks, or something. But it's actually a great speech and a lot of information. So we're gonna run that at the end of the episode.
Nice. And you had some questions for me about news that happened this week. I forget what they were.
The truth is, I need translation for stuff that happens in crypto news. So a couple things. One, MicroStrategy building decentralized ID on Bitcoin using ordinals like inscriptions. Things being built on Bitcoin. Can you explain this?
Yeah. So MicroStrategy, I think probably the largest single holder of Bitcoin in the world now, maybe just above the U.S. government itself. They announced. I was actually in Las Vegas last week for the Bitcoin for Corporations conference, their conference, and at that conference they announced this new decentralized identity scheme that basically takes verified credentials and keys and rolls them all up into Bitcoin so that you can reference them on Bitcoin, which is a universal ledger that's widely available. And then the first product that they're building on it is a pretty simple signature to plug in for Microsoft Outlook. So you could be like, oh, I get an email from Phineas who's like, hey, Alex, you send me that Bitcoin we talked about. And I'm like, wait a sec, this doesn't have the orange check mark. It's not Phineas, right? Mm-hmm. And it's pretty straightforward. I don't know, decentralized ID, a pretty big topic, and interesting to see MicroStrategy getting in there with some Bitcoin software product.
Super quick follow-up. Do you like this? Your opinion, it's being built on Bitcoin. This is like, we hear this a lot from our guests on the show repeatedly. They either fall into one camp or another typically. Yeah. People like Bitcoin being used in this way. Some people don't. What's your take on it?
No, I like it. I think it's quite interesting. I think DID is interesting, and Bitcoin's a universal ledger, so it's widely accessible. I think there's other approaches to this. Microsoft's Ion stores the credentials in like a Microsoft server, but they're secure. And Block Inc. is working on something at TBD. It's called TBD. There's a number of approaches. I'm not really an expert, but I like the use of Bitcoin. I think it's interesting.
Number 2, Tether sees record net profit of over $4.5 billion in first quarter of 2024.
I mean, keep in mind, most of their profit is coming from earning interest on the treasury collateral that backs the USDT stablecoin. They don't pass any of that through to their token holders. If you're a bank and you hold treasuries, you typically pass some of the interest you earn back to your depositors, right? That's what a savings account is. So, I mean, they figured out a little bit of cheat code. It won't last forever. It's very tied to interest rates, but, good for them.
Okay, number 3, the Justice Department charges Roger Ver with tax fraud. Tell me about this.
Yeah, this is tough to, I don't know. We don't know the facts here, and I see what the allegations are. Apparently, Roger Ver, in exiting, giving up his U.S. Citizenship, you have to pay like a bunch of taxes. I don't know the rules, but it's like there's a one-time penalty, and then for like you have to pay like several years of taxes you would have paid. And the Justice Department's alleging that he hid or mischaracterized some of his Bitcoin wealth, and owes $47, I think, or $48 million in back taxes. He was arrested. To me, it's kind of surprising. Like, this is a guy who, certainly at the time, had millions, hundreds of millions of dollars of Bitcoin. And he was a very early adopter. Sort of fell out with the Bitcoin mainstream community because of his diehard support for Bitcoin Cash, the fork of Bitcoin. But I mean, you'd think he could just pay that potentially rather than like have to be arrested over it. I don't know. We'll see.
And lastly, Binance founder Changpeng Zhao, sentenced to 4 months
CZ
in prison.
So he paid $4 billion fine, and now he's spending 4 months in prison. And I think a lot of our audience will know that 4 has been a joke that he's been saying for years. He had a tweet that was like, things you need to remember, like whatever, and I'm just going to refer to these going forward by these numbers. And 1 was like, I don't know, XYZ, like, don't invest more than you can afford to lose. 4 was like, ignore the FUD. And then he would just get into the habit of just tweeting 4, or like there's a picture of him holding up 4. And that was like 2 years ago. And now this man is only serving 4 months and paying $4 billion, and it's like, dude, what?
It's classic crypto.
Do we live in a simulation?
It's classic crypto community stuff, though. It's like, of course, there's going to be some deeper thing going on.
It's very strange.
It's very interesting.
Yeah, and you got millions of people online following someone like him, and like, I mean, this one was pretty obvious. I mean, really, he was known for 4.
Yeah,
4.
Fascinating.
And then he gets 4 months and $4 billion. It's just like, you almost can't write it. Some people were saying it's too lenient a sentence. I would just point out, first of all, that he paid, I think, the highest fine in the history of the DOJ. And also, I mean, banks have done this activity a lot. You don't see any bankers that have gone to jail for it. So I think it was probably a reasonable thing. And look, we also found out during this whole thing that Binance was solvent. So just from my perspective, it's not a Sam Bankman-Fried situation where he stole money from his users, right? So, but anyway, he broke the law. He's serving time, and I guess he'll get out in 4 months. I don't know. I guess it's gonna be interesting to see what CZ does next.
He'll pay $4 million and he'll get out in 4 months.
Yeah. All right, let's go right into the show. Let's go now to our guest, Bimet Abibi from Galaxy Trading. As always, Bimet, welcome to Galaxy Brands.
Thanks for having me.
So it feels from a news standpoint certainly less busy than last week and some of the prior weeks with all the data and the Fed meeting. But I would say that, in our markets, Bitcoin rose from the 56K area all the way back into the 60s. And, now we're at 62 something or other. Like that felt good being back above 60. What was your take on that? Was it just sort of like oversold and then like, I don't know, people overreacting one way or another?
Yeah, no, I think you had a positive catalyst in broader risk markets with a dovish Fed. In addition, you had an oversold market that was at support, 100-day moving averages, 60K support level, et cetera. And, you started to see a little bit of, optimism around ETF flows, et cetera. And then you had a bit of a short squeeze. And so you had a a relief rally in Bitcoin, and you had similar price action in all risk assets basically over that time period, and I think it's warranted because I do think the high and front end yields are in, and that's what kind of Powell stated implicitly at the last FOMC meeting. And that's generally good for risk. And the first order reaction is for people to buy risk assets and for vol to come down and for dollars to sell off. And that's kind of what you had happen.
Yeah. And then what else? I wanted to ask you a little bit about sort of a more macro thesis, especially since we don't have a lot of data to come through today. Where do we see, let's say if Trump is elected, like what do we get any hints? Because I remember when he was president the first time, he was tweeting at Jay Powell saying like, you got to lower rates and stuff.
Yep.
He's meddling a little bit there. I mean, where do you see were Trump to be reelected, a Trump administration going on? Biden's always talking about, the White House always talking about Bidenomics. What would Trumponomics look like in your mind?
Right. So I will highlight two things to frame this conversation. Right. So I believe it was in 2018-ish when front end interest rates were at 2.5%, and Trump was starting a trade war with China, and risk markets started to get a little wobbly, right? And Powell, at that time, because of those concerns, partially because of those concerns, and most likely because of pressure from the White House as well, decided to cut interest rates when there was no need to. Unemployment was almost at structural lows at that time, and Powell still decided to cut interest rates in 2018. And this was a time when inflation wasn't as much of a concern, right? People hadn't really thought that the U.S. could be in a 6, 7, 8% inflationary environment ever. So I'll caveat it with that. But I think the key takeaway is that absolutely the White House can have an influence on central bankers. And I point to that as kind of the main example, because if you look at the set of facts, which was, unemployment around like 4.2%, right? And having achieved solid normalization, the Fed was at that time methodically raising rates, and, they were getting back to a place that felt more sustainable, and yet he decided to do an insurance cut at that time. And so that's one. And then the second one is how a second-term president behaves. And I'll give you Barack Obama's first sort of address. You know that event where they do comedic speeches?
Yeah. It's the
commencement.
What's it called? It's the Friars dinner or whatever. And
sure, where he addresses the media.
Yeah, it's
right?
all like, there's the White House Correspondents Association dinner. Is that the one you're talking about?
Exactly. Yeah. And that was one of my favorite correspondence dinner speeches, because essentially Obama was like, yeah, I want to fix immigration policy. You know what? Bucket. I'm just going to do executive action, right? Oh, we have to address this issue. Bucket. Executive action, right? Student loans or whatever it was at that time.
Was he saying bucket?
Yes, literally bucket,
Okay.
right? And we can say it here, but
Right. We know what he's referring to,
Yeah. And that's the kind of mentality that a second-term president really comes into, because there is nothing on the other side.
Yeah.
Right? And now, take the example with Trump, and you throw in a guy that is probably less fearful of the court system than he's ever been in his entire life, which is
assuming he gets elected.
Correct.
Yeah,
assuming he gets elected.
Yeah,
right? This is all under the assumption, and factually speaking, Real Clear Politics has it, neck and neck, leaning a little towards Trump on the betting odds.
Yeah.
But it's an even race. We just, we're just kind of looking at the hypothetical.
Yeah.
And so you've got this guy who's not afraid of impeachment, because he's been impeached a couple of times. He's not afraid of the court system anymore. And he's on his second term and nothing to really lose, right? And so that's the recipe you have if he enters office.
Yeah.
Now, what can we assess about his economic policies that he wants to pursue? Well, tariffs, right?
Yeah.
Tariffs against China, tariff against, auto imports, basically USA first.
Yeah, he's a protectionist.
Protectionist.
Kind of,
And we know what that looks like in the commodity sector. That is commodity prices higher. right? That will ultimately translate to cost of goods increasing, and that those costs being transferred to consumers via retail prices, right? So the commodity complex not looking great under a high tariff regime, right? Another sort of lever that a president can pull is with his treasury policy, right? If you issue a ton more front-end paper versus back-end paper, et cetera, and treasury buybacks. And so the treasury is actually a pretty strong agent in terms of impacting economic policy.
Yeah.
And you can appoint folks that will sort of implement more dovish kind of policies, ones that will kind of reduce, friction in the economy and synthetically give you like lower rates, right? And in addition to that, you can, appoint Fed members that are also more dovish, right? Including, there's some ambiguity whether or not the Fed chairman can get fired or not. But I will tell you, in the construct of an empowered president that doesn't care about winning another election or the court system, I would guess that he's going to do whatever he wants, right? And so if you combine high tariff policy with a loose treasury and slightly more dovish kind of Fed members, it's going to be inflationary, right? I don't see how Trumponomics isn't materially inflationary. And so in this election, you're deciding between inflationary policies that are pretty blatant and, in your face. And then you've got the other side, which is like, they still want excessive spending and stuff. They want to, do, student loan forgiveness. They want to potentially make it easier to get second mortgages on your homes, via the Fannie and Freddie being able to potentially make loans, et cetera. And so really, like, there's no outcome where I don't see a second term for Biden or a second term for Trump as being inflationary.
So, yeah, is that the like the 1970s, 80s, like the second wave? Is that
absolutely?
How worried are you in general about a second wave of inflation?
Very, very concerned. And so right now you are seeing the signs that the U.S. consumer is slowing. Right. There was actually a very interesting piece today that how Wall Street is kind of mismeasuring the debt burden that's on U.S. consumers right now because of these buy now, pay later programs that don't even actually get captured in
that doesn't
data.
show up in the credit card data or
Correct.
the
And the credit
personal
card
loans.
data is starting to look worse.
Yeah.
The auto loan data is starting to look worse, et cetera. And so, while there are signs that the economy is slowing, and while that's deflationary, I worry that the response of the Fed in terms of cutting rates, the response of Congress in terms of more stimulative efforts, especially going into an election, will ultimately kind of outweigh the drag that you get from a slowing
And
consumer.
you and I have talked about this a little bit too, but some of the infrastructure bill money and the Inflation Reduction Act money
still hasn't been spent.
Hasn't been spent. The feds, federal government, rightly pushed a lot of that down to the states to figure out how to do it because they can't literally micromanage. I'm happy they actually acknowledge this. They can't literally micromanage the spending on projects all over the entire country from Washington.
Yeah.
But the states haven't spent it all, so they're still spending, which is like, and some of it's not even spent at all yet, right? So there's that's also like lingering inflationary pressure as well.
Yeah, no, and when you're consistently running $2+ trillion deficits, right? Like that's an inflationary.
It's a lot of spending.
That's a lot of money, and so I think the reinflation risk is super real, and there are ways to play it in the market, but right here, right now, I wouldn't own long end fixed income, especially U.S. fixed income, because of the fiscal path and how unsustainable it is. But it also just, you don't get paid enough for that risk.
Yeah.
The risk that inflation is like well above and beyond the returns that you're going to generate. The risk that, there's default risk, with Congress perpetually have to repassing debt ceilings, et cetera. And so I think, bonds are just still very mispriced in the U.S., and then that creates such weird dynamics with the dollar, right? Is like high inflation in the U.S. and higher interest rate policy ultimately, like, is that dollar positive, negative? Like, there's so many variables up in the air that it's really hard to trade. But ultimately, I do think that crypto will find some footing in that environment because one thing I know for sure is that monetary policy is defined, and it allows me to plan accordingly.
Yeah.
And so it's really hard right now.
Yeah.
Let's
It
put
sounds
that way.
complicated. And I was going to mention too before you said when Trump had been pressuring the Fed to act a certain way, Biden has tacitly been doing, not as openly as Trump tweeting like lower rates now or whatever he tweeted back then, but Biden has been predicting that rates would get lowered by the fall and stuff like that, like saying it publicly. That is pressure.
But
as well.
I mean, did you even see the guy on his economic council try to talk about debt?
Yeah, that was in the Stephanie Kelton movie, the Finding the Money. I actually haven't seen that movie yet. I heard it's good, but I did see he could not explain how money is created.
Could not. And I would tell you that, what's the sad part is that if you ask any one of our, congressmen, wow, there's like 460 of them.
435 members of the House.
430 of them. Like, I would bet that, maybe like less than 10% could answer those questions in a reasonable way.
Yeah.
And for the Senate, you'd hope it's better, right? Like,
Well, that's what I liked about Neil Kashkari one time, and it's the first vocal clip on our intro. He was like, yeah, we just have infinite cash. We just push a button and print it. Like that's the simplest answer.
and Powell's given that on 60 Minutes before too, et cetera.
Yeah,
But
that doesn't inspire
really,
confidence though in
it
our
doesn't
leaders. Yeah.
because there's nobody that's like, oh, okay, let me look at these CBO projections and what do they actually mean? And like, 10 years forward from now, like what are people going to be upset about? And like, how can we like try to address it now? But there's no possible way of like addressing it in our current political economic construct.
Right, because there's no the 2-year term cycles.
2-year term cycles, yeah.
Yeah, you have no incentive to
Gerrymandering,
do
Supreme
well by
Court,
your
yeah.
grandchildren as a politician, right? You've
It's
got to
just-
do well by the grandparents who are voting for you now.
Absolutely, and the grandparents that are donating to your campaign now.
And they do vote and donate.
Absolutely, and so it's just it's all coming to a head right now, and the policies we make now have such severe ramifications on what we do going forward, and it's to the point where even like the Fed like cutting now, like the impact of reducing interest expenses is so huge when you compound it over time.
Yeah. One
and-
little cut could save us trillions of dollars in 20 years, right? It's like crazy.
And so that's why it's hard for anybody to really be in that Powell seat and not want to cut interest rates.
Yeah.
It is.
Well, the country needs it, really. I mean, the country's balance sheet needs it badly.
Yes. But we
again,
can
if
have
we-
this debate another time.
But if we have 20% inflation like we did in the 70s,
yes,
the country doesn't do well.
does not.
It's a very tricky situation. Next time, I want to ask you about the Japanese yen.
Absolutely.
What
We've
the
been
hell's
meaning to
going
talk
on
about it.
with that thing?
Well, their intervention is not working.
No, I see it.
It's back up
Well,
again.
let's do it. It seems like they need inflation though to get off. They have an incredible amount of debt too. Eventually, they got to
Yes, they
inflate
need-
that away probably.
Yes.
But they don't want it to be like crazy rapid.
Yeah,
So they
that's also
because they stepped in twice last week.
yes.
And didn't really.
They took dollar
brought
yen
down,
from
but-
160 to a low of like 152, 151.84.
Yeah.
And we're now trading closer to 156.
Yeah, it's like coming. Yeah, the trend is intact. That.
Yeah.
All right, we'll talk about that another time. My friend Bimet Abibi from Galaxy Trading. Thank you so much.
Thanks for having me.
Let's go now to our guest, Austin Campbell, professor at Columbia Business School. Austin, welcome back to Galaxy Brains.
Thank you very much. Happy to be here.
One of very few repeat guests. I think I was saying this to you, Mike Novogratz, Nick Carter, Tyler Williams, but not maybe one. I think Trey Aslanian from Galaxy Trading also, but not many others. Really happy to have you back. I thought the time was very apropos for a number of reasons, but if you recall, if you go back and listen, I think you were on maybe like February of last year, 2023. So it's been just a little bit more than a year, and we talked a lot about stablecoins. Used to be the portfolio manager for USDP at Paxos. A lot of stablecoin news happening. Does it feel like the stablecoin Super Bowl? It's starting to get interesting. I mean, it has been, but
Yeah, I mean, it's the classic stablecoins are relevant about once a year type cycle. And what I would say is it's just become this thing that as they continue to stick around and grow and increase in usage, everybody is realizing they have to grapple with them, right? These are not going away. And the longer you wait, in some ways, the harder it gets. So every year, the momentum to do something essentially increases.
Yeah, it's like a coiling spring. And so one of the big advancements in the discussion has been the introduction of the bill in the Senate Banking Committee by Senator Lummis and Gillibrand, Republican and Democrat. What is that just at a high level? What was in that bill? Is in that bill, that proposal?
Yeah, so I'll sort of summarize that bill as this is Lummis and Gillibrand's attempt at a stablecoin framework in the United States. And the high-level points are as follows. One, stablecoins have to be bank-like entities. I say that because they don't literally have to be banks and that they engage in consumer lending, but they have bank supervision. And with the way the bill is written now, I think there are some technical issues with it, but the goal is to create a form of like isolated entity to hold the stablecoins with prudential regulation. Fine. It specifies things like reserves, how you manage operations, capital levels, those sorts of things. Two, it has all of those requirements attaching and essentially forcing people into a framework. No more unregistered, just money services businesses type things. Mm-hmm. And if you want to be a stablecoin in the US, you've got to come here and register. And then the last part is what I would describe as a ban on algorithmic, synthetic, crypto-backed stablecoins, which to me I find a little bit confusing and misguiding because it's one thing to talk about how you represent or how you market things and another thing to say literally you can't do it, because I think there are some weird implications to that bill if you were to start, tokenizing some forms of traditional assets that could get strange quickly.
Yeah, so let's talk before we get in. I want to get into some of the specifics of the bill and some of its implications, but also is this there had been a big push, I think it was 2022 actually, in the House Financial Services Committee before Representative Patrick McHenry took over as chairman when Maxine Waters was chairperson of the committee. And McHenry was the ranking member, to do something like this. Are these bills similar? Are they related? Do you need both? I know Representative McHenry has been saying, and he told the Bitcoin Policy Institute a couple of weeks ago in Washington that he really wants to get something done on stables this year. How do these relate?
Yeah, so both of them are attempts at the same thing that sort of bake the cake somewhat differently. They are both cakes, but they are different kinds of cakes. Let's put it that way. I would say McHenry Waters has been in progress for a long time. There's been contributions from the Democratic side. There's been contributions from the Republican side. I still think there are some technical issues to be ironed out with that bill. It has some of the same reserve problems, for instance, as Lummis Gillibrand. But a lot of that framework works better in terms of fitting them into the U.S. financial system. And the biggest question that I think McHenry has grappled with a little more than Lummis Gillibrand is state versus federal supervision of stablecoins, which I think is actually a very important point to get right in both directions. I would tell you, thinking about the political dynamics of how you get things done, neither Lummis nor Gillibrand really have a say in Senate banking, whereas McHenry, as you just said, is the chair of the House Financial Services Committee. I would imagine if a bill moves, it is significantly more likely to be McHenry just because of the political heft and ability to make deals with the senior Democrats in the Senate than the other way around.
Interesting. So let's talk about the reserve requirements and collateral stuff. I saw you had posted about this on Twitter, formerly, or X, formerly Twitter. What are the issues with it? Because my understanding was effectively both the House Financial Services bill or proposals and Lummis Gillibrand on this topic require like a variety of mostly just like short-term treasuries or cash as the collateral. Like what's wrong with that? Or is there something more that's needed?
Yeah, so I think the last time I was on here, you later made fun of me for calling myself a grouchy fixed income person, but this is where you find that was truth in advertising, because the problem that we're having in this bill is it is like the view of an outsider looking at sort of, call it, cash stability things without truly understanding the dynamics and trying to reinvent them. So I've said to crypto folks, you guys keep trying to reinvent stuff that are solved problems in finance. Stop. It's a little like I've never seen a real wheel, so I make a hexagon instead of a circle. And it's like, could you just use a circle? And so here the problem is modern money market funds, especially government money market funds, which is what these are supposed to look like post-crisis, try not to be vehicles that essentially just suck in T-bills and trap them forever. Because when you do that, the Federal Reserve has a very legitimate and correct point that these are systemically disruptive in times of crisis. Because what will happen is banks are going down, there's stress in the financial system, so people need more collateral to post. And by the way, all of that collateral is now being eaten by stablecoins that can't let it back out. And so that causes a shortage. This is no bueno. And so what you would want to do to deal with that is something called reverse repo. And the way that structure works is I have cash, I lend that cash out, and the collateral I typically take for that is longer dated treasuries, which at a time of uncertainty is good because I have long duration while interest rates are going down because things are bad, which means my collateral goes up in value. You have right way credit risk, but you're also not sucking up all the liquidity. In fact, you're providing liquidity to the system. So if you look right now at what BlackRock does, to take somebody sophisticated, for Circle's reserve fund, it's 100% reverse repo.
Yeah.
That is not a coincidence. And I think without that, I would oppose this bill, and I think the Federal Reserve would oppose this bill, and for, quite frankly, probably correct reasons.
Yeah, and it's process. It's literal. It's pure financial like engineering reasons that it's not a ideological position that needs to be different. You're saying it's stability.
Correct.
And they can't just sell. Why can't they just sell the short dated treasuries? Is it because unless people come in to redeem the stables, like they have to hold it as collateral, right? So they can't actually.
Right. If you look at what else they can hold, it's like bank deposits.
Yeah.
And just so people know, in the United States, you get $250K of FDIC insurance. And while there are sweep vehicles and whatnot, if you're running a $100 billion stablecoin, there's literally not enough banks.
Yeah.
Right. So are you telling people sell your T-bills and buy stuff that's credit risky in a time of crisis? No, that's bad. Now the stablecoin will collapse or trap all the T-bill. Again, it's just the wrong instrument set.
Yeah.
They misunderstood the problem.
Why do we think that because the House bill had basically similar, I think it was effectively T-bills 90 days or less. I don't recall if it had reverse repo. I don't think it did.
No.
So like, why is this? They're just thinking in their heads that like those are the least risky, most liquid instruments?
I think the problem they've run into, if I'm being honest, without naming names, is that they talked to some people in the crypto industry who have run stablecoins and maybe haven't done a great job of it and just adopted what they said.
So I don't know. Do you have a sense of the likelihood of anything from either side of the Congress or either chamber, I should say, passing on this? Or like, does it feel like the temperature, that coiled spring we talked about, is it coiled enough yet for something to really get done?
So the counterbalance here is it's an election year, and you should always bet against progress in an election year. However, when you want to get things done in Washington, when you have a split situation in the House and the Senate, you get it done by having something each side can trade. And here, the deal that would be in play is probably cannabis banking, which is something the Democrats want, and Schumer apparently feels strongly in favor of. And by the way, I, as a New York Democrat, support. And on the other hand, you've got the Republicans wanting stablecoins. And to me, that is the trade that could potentially be on the table, is if you trade the McHenry stablecoin bill in some form for cannabis banking, that's probably strictly better for the country overall and something that could get done because both people get a win. If you want it to get through this year, both sides have to get a win.
Yeah. What about like, so you mentioned the algorithmic and synthetic and whatever, I think they mostly call it algorithmic stablecoin are prohibited. Well, what's the problem with that? You mentioned a core, a relationship to or an analogy to instruments we have in the traditional financial system. What is that? And also, like, we'll talk about some of the other crypto stablecoins that might be affected.
Right. So I would say, again, as somebody who's worked a lot in cash stability products, as you work your way out on the risk spectrum, there are a lot of things that I'm going to say attempt to be stable with varying degrees of success, risk, and return attached to them. And what matters to me is just representing things correctly. So if I'm thinking of a stable coin that I would feel comfortable with my mother using for payments, it's something that looks like what's in the McHenry bill, right? Like, again, with some small tweaks, but basically it's dollars-ish locked in a box, and that's how the thing operates. Good. That's a government money market fund. It's fine. They work. But that's not an argument against the very existence of things like prime funds or maybe structured notes or maybe like paired basis trades, right? As you look in the financial space or even like AAA securitizations. But what it is an argument against overrepresenting the safety of those things. So I think the mistake in this bill is if you have banned things that hold a peg to the US dollar that don't follow this format, well, if I tokenize a structured note at a bank, is it now illegal?
Maybe.
Yeah, but that's like a weird outcome,
because
right?
They're not saying come in and register to do it. They're saying actually that's just straight up banned.
Right. So now I have a weird situation where if I do a thing on a traditional ledger, it's legal, but if I put it on a blockchain, it's not. That's bizarre, right?
Yeah.
Like it shouldn't be the case that I can have a financial product and by moving from an Excel spreadsheet to an Access database, like I change the legality.
Yeah.
So I would say, to me, the better strategy here is to say if things want to be stable coins used for payments or represented as such with promises of safety, they should have to fit into the framework of the bill. And if you don't, you can't market it or call it that, and you have to be honest about the risks.
And it's like calling yourself a bank when you don't have a bank license. We come after you for that, basically.
Correct. And like that's actually a great example because there's a very narrow set of exemptions to that. But you will notice like even bankless had to become bonkless in California because you can't use bank, right? Like the only things that can actually use bank are going to be things like literally a blood bank, right? If you're not a financial services business. And by the way, I think that's fair. I shouldn't be able to just take 3 dudes, rent a tiny office, and call myself a bank. Like there are a lot of strings attached to that.
It's very deceptive. It could be.
Exactly. And that's my point here is get rid of the deceptive marketing, get rid of the false promises of safety. Don't have Do Kwon going around calling Anchor a savings account.
Yeah.
That stuff is bad. But on the other hand, you mentioned Athena earlier.
Yeah.
I don't think Athena should be illegal. Like I've actually talked with them about this myself where I told them, I don't think it's right for you to call yourself a stablecoin, but that doesn't mean I don't think you should be able to do it. I think it's a cool project.
Right.
Just represent it correctly.
Yeah, I mean, I think of it in some ways as they're doing the basis trade basically. So it's kind of like a market neutral hedge fund product they've tokenized, right? Which is, and those trades are done across finance of a whole range of time. So it's not a crazy idea.
No, and more so, I would say I think it is a societal good to democratize access to uncorrelated high return strategies. Like it should not be the case that we live in a financial system where only extremely rich people have good investment opportunities.
Yeah.
To me, it is again back to you have to represent the risks cleanly, be clear about what you're doing, and be fair. Like I'm a transparency maxi in that way, call it. But I also don't believe that it should be the case that, well, they can't do it. Like we should hive this off and only like Steve Cohen should be allowed to make money like that.
Yeah. What about Tether in this situation? Because they are the largest stablecoin. And the bill, it requires you to come in. We didn't talk about the licensure portion of this, but you said they have to sort of be bank-like, right? You have to be a depository institution. I think there's, like you said, there is a state trust pathway and a federal pathway. There's some kind of threshold where, like, if you become like too big, then you have to go the full bank, federal bank way. Whatever. To be honest, like that's a sort of like horse trading. Probably. I know there was a lot of back and forth. You mentioned about the state pathway in the McHenry Waters proposal. Presumably Tether would have to, whichever of these is adopted, they all require some form of registration as a trust or as a bank. Tether would have to, right? Presumably.
Yeah. So I think the way to think about this is, this sort of flew under the radar with all the headlines flying around in crypto. But recently, I believe it was OKX, don't quote me on that deplatformed Tether in Europe because of Mika.
Yeah.
And you're going to see a similar thing if a stablecoin bill passes in the United States, because what it means is you're going to need to come here and register, or you're going to need to be in some sort of regulatory regime that the U.S. is going to be willing to say is roughly equivalent. Like, I think if the U.S. passes a bill and Europe's got Mika, they're probably going to horse trade with each other to give equivalency rather than ban each other's products. That's silly. Yeah. And not how regular finance works. There is equivalency treatment. But what it means is Tether can't be this amorphous offshore, we're never going to show anybody our cards sort of thing and be inside the perimeter. They're going to have to make a decision one way or the other. And I think that's a feature, not a bug for this bill from the view of the writers.
Yeah, you think it's going to happen sort of anyway? I didn't realize that this could be happening to them already in Europe, which has pretty strict stablecoin rules now. Actually, do you think, is it already happening? Is Tether the in your mind, I mean, I don't know if you know. I don't know. I have impressions, but that's just my impression. Are they the Wild West Tether that they may have been in the past, or with this stuff in Europe, with the potential for it here, is it different?
They've definitely been evolving, right? I would say to me, Tether is on a path that's somewhat similar to Binance, right? When Binance started, if we're being honest with each other, as somebody who used to run BUSD and knows a little bit about that organization, they definitely had some serious issues. You just saw CZ plead today. And so even the people running it admit that happened. But also they have genuinely tried to improve them over time and gotten to a place where they've gone from it was pretty bad at the start to actually it's pretty good now. And Tether, I think, is on that same journey. Like, they are not sort of a pirate ship as they are represented. Now, they're not perfect either. They still probably have some jankiness in there. But, like, they've been cooperating with the DOJ and U.S. law enforcement in foreign nations and trying to force out the worst actors. So, what I always tell people about Tether is the real Tether skeptics who are like, it's all a scam, they don't have the money, and it's all criminals are definitely wrong. But Tether maxis who are like, this is the best thing ever and it's perfect, how dare you criticize it, also wrong. The truth is somewhere in the middle.
Yeah. And then if we think about the state, I just want to throw this out here because I know another issue was like stable coins. Like, why couldn't Walmart issue a stable coin? I mean, this is one of the, feels to me like in some of the, as I've been following some of the debates on these various bills, that sort of this idea kind of got jettisoned relatively early, but was initially proposed. Why should it be only banks? Is there a reason why really it should be only banks? Is there not some, maybe there's no way to just sort of rhetorically craft a threshold without something like banking rules? But like, why couldn't, think about Meta, right? Or Facebook at the time, they wanted to do Libra. That wouldn't fly in this regime, in either of these regimes from the House or Senate that we're sort of discussing. They're not, they'd have to become a bank. Or a bank-like entity. Like, is it, in your mind, just maybe this is more personal opinion, but like, should it really be only banks? Like, or is there some way to do prudential and regulatory oversight of a non-bank? Or I guess that doesn't really exist. What are your thoughts on that part?
Yeah, I mean, I'll give something that's probably a hot take for all sides, which is I don't think banks should be stablecoin issuers either. And what I mean by that is that banks exist for the purpose of credit intermediation.
Yeah.
And so the idea being, I'm going to take deposits, I'm going to take those deposits, and I'm going to go lend them for real economic activity. That's a valuable service. But that doesn't necessarily mean that somebody who wants to buy a cup of coffee should have to lend money to a real estate billionaire just to do that. That's kind of how the current system works when you also give banks a monopoly over the payment system. And there have been times in history where these systems have not been bundled with each other. And in some ways, maybe we should consider going back there. I would say, to your point in this bill, this is a nuance that I think there's still a lot of fighting about, which is, does an entity that has a stablecoin issuer under it have to be a bank holding company? Because if the answer is yes, then what you said is true. And I think that breaks a lot of things, actually, because it's going to be hard to have some of the tech development things in there. On the other hand, if they don't, actually, Walmart should totally launch a stablecoin with, I will say, one important caveat. So another trend, and Athena is something of an example of this, but maybe a better one is Agora, which launched recently, is the old stablecoin issuers made you the following deal. Give me $1 and cool, thanks, I'm going to keep all the profits.
Right.
That's a good deal if you otherwise didn't have access to dollars. So if you look at the holders of these things, it's largely non-US persons because that's where the economics make sense. That is a bad deal if you could just buy a money market fund.
Yeah.
And so I also believe that in the future, stablecoins are going to have to share a lot more of their yield. And that starts reducing the value of everybody launching their own stablecoin because just like why at that point? If it's competed away and becomes essentially a asset management business, Walmart shouldn't and doesn't want to launch one.
Right. That's interesting. Yeah. And it is, by the way, I mean, like in your Fidelity account, you can hold a government money market fund. It operates exactly like cash. Like you can literally do you can have zero cash and $100 shares, $100 worth of shares of a money market fund, do an ACH, and Fidelity will just instantly send it like it was cash. That's basically what we're talking about with a yield-bearing stable, right? It's like it just if it's not in flight, it earns interest. When it's in flight, eventually it earns interest at somebody else's place or whatever.
Exactly.
Pretty straightforward.
And in many ways, that's why I've always been so interested in stablecoins, is they are in large part a new form of money, right? For exactly the reason that you just described, which is in the past, we had like physical money, so like a physical dollar bill, and it kind of suffers from Warren Buffett's critique of gold, which is like it's just a thing that sits there. It's not doing anything. And then you also had productive investments. But even in the banking system, if you think about the mechanics, so like if I have an account at JP Morgan and you've got an account at Bank of America and I have to pay you like $1,000 to settle up for a bill for some crazy outing that we had together, then what happens is, assuming banks are not holding a liquidity layer here, so let's say it's been exhausted, JP Morgan has to go sell $1,000 of stuff, get that $1,000 of cash, send it to Bank of America, who gets the $1,000 and then goes and buys stuff to invest it.
Yeah.
A stablecoin essentially allows you to eliminate that gap between the process of investment and the process of payment. It can be within the stablecoin vehicle. This is invested in overnight reverse repo. And when I send it to you, it just stays invested. So we have eliminated this friction that exists in the current system by essentially combining these functions technologically.
It's smart too because a government money market fund is not a security, right? It's not like an equity vehicle, right? So we can transfer it.
Well,
or I guess it is currently.
So the answer is
yeah,
both yes and no. The answer really is it depends what kind of wrapper you're talking about.
Yeah.
But that is a very U.S.-centric concern too. The U.S. is one of the few places in the world that does not have like proper regulation for just like payments.
Yeah.
Right. So I would tell you the right way to think about this is there should be payments companies where what they can do is just hold your cash, bankruptcy remote, and custody for you. So it's not like PayPal's property, it's your property, where PayPal is the custodian. And then PayPal charges you a fee for that service and pays you the rest of the interest. And if everybody can do that, then we have a system where people who want to use the system for payments are not essentially paying a giant invisible subsidy to those who are using the system for borrowing.
That's interesting. Yeah, I can see how splitting them out can make a lot of sense, and I guess so it's not the securities issue that I was thinking, but it's more like instead of when I do the ACH out of that Fidelity account with the money market fund only in it, it is liquidating, converting to cash, I think, and then sending cash. It just sends the shares in the mutual fund to the amount that I need. Like it just is money.
Correct.
And the yield follows it rather than like having to go in and out and then everybody. And that's the other thing too. It is more equitable because the average person may not know that they should take their savings account where they're earning 0.01% interest and actually put it in a brokerage account which has cash features, but put it in a money market. They'd earn 5% right now or whatever it is. Like it would automatically happen. You wouldn't have to have this weird disparity where the average person, the working person, just gets none of that yield.
So I think that is an extremely good point and is one of the two huge features this creates. The other one is so when Silicon Valley Bank was going down, there was this whole sort of theme that emerged of you should have due diligence to your bank if you were going to leave money there. And to me, that's crazy. And the reason I say that is I started my career at JP Morgan in distressed debt in 2009. And let me tell you, due diligencing banks when things get creaky is a 100-hour-a-week job. So one, where are you doing your actual job if my job is due diligencing my bank? And two, for many kinds of businesses, it's just not feasible. So let's say I am a small to medium grocery store chain and I need to receive money from people because they're buying tomatoes and bread.
Yeah.
Am I supposed to have 50 different accounts and be allocating them to stay under $250K and then keeping track of net of my receivables versus payables versus there's no way for a medium scale business to stay under the FDIC limit. It's just not feasible. And so you're essentially saying to anybody who runs those kinds of businesses, also you should be like a bank debt trader to understand if your money is safe.
Yeah, it's wild. It should be what the banks are paying into the FDIC and membership and what our taxes are paying for. That's the whole point. The FDIC has prudential authority over the banks. They could have gone in and said to SVB, whoa, your books look bad. You need to clean this up immediately, or we may even take you over. Instead, they waited till it was insolvent. That's literally their job, right? That's what prudential oversight is, right? That means they can reach into the balance sheet and say, you have to hold this, you can't hold that. Presumably, they're supposed to be doing that you're right. It's not just one grocery store. The entirety of the U.S. economy cannot perform this diligence on banks. That's supposed to have been outsourced to the regulator. Otherwise, I don't know what they're doing.
Correct. And, the other part I will say, though, is it goes back to an old Yogi Berra quote, which is predictions are hard to make, especially about the future. Like bank regulators will never be perfect either.
Totally.
And so question, should there just be a simpler vehicle, maybe with lower returns, that people could use if they don't want to deal with the headache?
Yeah.
Or, conversely, because here's a way you could actually potentially obsolete stablecoins. So regulators, if you're listening and you hate stablecoins, here's the actual path. You might want to look at some of the economies that insure 100% of their bank deposits, just all of them. Because the way to get people not to worry about leaving their money in a bank is to tell them no matter what, you're safe.
Yeah.
And that requires a lot of structural change around how you think about banks. But if you don't want people wanting the safety of like government money market funds or stablecoins, the answer is you have to make the banks a lot safer. You can't just sort of magic the problem away by jawboning it.
Yeah. We could go on and on about stables. There's some other things I wanted to ask you about. There was some news last week about the founders of Samurai Wallet being arrested. At least one of them was arrested. I saw he pled not guilty actually already. Samurai Wallet was a anonymity enhancing service. That actually might be one of the government legal definitions somewhere. It might be FAT if I can't remember. I'm not going to call it a mixer because it was not a centralized service provider. For our audience who may know, it helped Bitcoin transactors connect to perform coin join transactions, which are ways for, say, Austin and I to collaboratively create a transaction using inputs from both of our Bitcoin stacks in a way that makes it easier for us to obtain on-chain privacy. We'll just say that. They did collect a fee for this matching service, but they never held funds. It's not like a mixer where you just send your funds in and later take your funds out and somebody mixes them around. It's not even like Tornado Cash, which is a different type of way of doing this. It's also a little different. But anyway, they were arrested and they were charged with two things effectively, conspiracy to promote or do money laundering and running an unregistered money services business. What was your thoughts when you saw this? I know there were a lot of people concerned about this. I saw Coin Center has been writing about this and many others.
Yeah, so when you look at the underlying allegations, as you said, you can really divide it into two pillars. And I'm oversimplifying here, right? But this is, essentially trying to make it understandable to everybody without getting into many, many like layers of, thought on the law. Part one is exactly as you said, conspiracy to commit money laundering. And basically what that means is that you and I formed some sort of agreement to launder money. And importantly there, you don't have to be any sort of licensed or registered entity to launder money. You just have to be laundering money, right? Like, so this is the classic, I'm disguising the source of funds and like hiding it for impermissible reasons through,
steps, yeah.
Exactly. And it is commonly used by criminal enterprises to disguise the fact that they are criminal enterprises to get their money into the U.S. banking system or any banking system, really. And that is illegal. And more importantly, that is generically illegal. Like I would say in many ways, the fact that crypto was involved here doesn't really matter. It would be just as illegal to conspire to commit money laundering with cash or with bank deposits or with, even like gold that we're going to hold in a vault. Yeah. Like you just can't do it. And so in the case of Samurai in particular, not legal advice, but you may not want to be talking openly about how your product is used by criminals to disguise the source of funds and maybe building features to facilitate that, as alleged, again, not confirming or denying. But if those facts are true, this seems to be a pretty obvious case down that parallel. Like just that, and that's not crypto specific.
And it requires
Don't do that.
intent, right?
Yes.
You have to knowingly commit to...
Or be like grossly negligent. Not mildly negligent, but like there were very clear signs that this dude wearing the North Korean flag around his shoulders like kept coming in to use your business, right? Like, guys.
Right.
So like it really bad. And again, not really specific to crypto. The other leg of the thing, which to me is the one that was much more concerning, was the unregistered like money transmission, money services business type leg. And the reason that was concerning is that, to summarize what the DOJ said is, well, you may not have specifically been this thing, but you somehow combined features or offerings in a way that made you into the thing. And to me, the problem with that is sort of, call it the malleability of that argument, which is, where do I put the bright line test to understand what is legal versus illegal if you're just going to argue that combining features in an unexpected way produces this outcome? Well, like what features? What's unexpected specifically? Like put differently, why are these guys a money transmitter and why isn't, like, for instance, my email provider? Because, like, I will openly admit right here, and maybe I am now apparently in the view of the DOJ saying I committed a federal crime. I've emailed with my family to settle up bills and used email to talk about settling in cash. So, like, I've now combined elements of service. Like, what? And so the sort of extensibility of that thing to sort of create this definition of, like, anytime something we put things together and a transaction happens, it's a money services business, is just way too broad. Way too broad. And I think this is an area where you have to really zoom out from crypto and ask, how does this work? Because, like, that sort of standard just produces a situation where I don't know, like, especially, and we'll get to this, I would imagine, like with what they said about FinCEN guidance and whatnot, like, how do I legally do business in the U.S. and e-commerce?
Yeah, it doesn't make any sense to me. And before we get to FinCEN in particular, I want to highlight a couple of things that they used as examples in this case. First of all, they said that you don't have to control. That most people think, and I think the FinCEN guidance says, that to be a money service business, a money transmitter in another parlance, like, you have to exert control over these people's funds. And my understanding was, take Western Union, the iconic money transmitter, right? Or I don't know how old it is.
MoneyGram, like
it's
those,
been around for like hundreds of years or something. You literally walk into a storefront in Boston and you say, I need to send money to my relative in Colorado, but should I put it in the mail and use the postal service? They're like, no, you just give it to us. We'll transmit a message to our office in Colorado that says give them that money. It's even how the Hawala network kind of works, to be honest, right? Like, it goes in one side, it's in flight, but while it's in flight, it's in their control. And so they could abscond with it, right? The money transmitter could just not pay it out in Colorado, but take it in Boston. And so there's rules around this, right, to protect the consumer and the user. So control is always thought of, I thought, as an iconic and integral part of classifying you as a money service business. In the case of Samurai Wallet, there was no control in that sense, right? Because while it's like a matching, so it's almost like a matching engine on an exchange. It's a little different, I guess, but it's similar in that it connects a buyer and a seller. In our case, it connects two people that want to enhance their privacy. But the Samurai never holds the keys to those funds. They can't abscond with the funds, and they may not even know who used them. The suit alleges that control is actually not required to be a money service business, and they use examples of a frying pan. When you cook food, is it in control of it need not be in sole control of the egg you're frying for it to obviously have facilitated its cooking. Or a USB cable could transmit information. Is that not that it doesn't control it necessarily, but it would still be seen as transmitting the information? It seems like a truly wild argument to me, and in conflict with really what FinCEN, which, by the way, is the regulator for federal money service businesses, what they've said for, frankly, years on this topic. Like, what do you make of that discrepancy between the DOJ's criminal suit against this founder and the FinCEN guidance, which is part of Treasury? I mean, a different branch of the government, or different agency within the executive branch of the government.
Yeah, I mean, is the DOJ seriously trying to argue that swap meets need to register as money transmitters? Like, this is a little bit, like, out of the blue. I would say, so the analogy I used when I was talking with one of my students about this was the situation is a little bit like you've got an octopus. It's got like 8 arms. And all 8 of the arms are now doing something totally different with a different interpretation of the law, in some cases unwritten. And helpfully, they don't agree with each other. So now you've got to ask, like, how am I supposed to do business legally? If FinCEN is not in charge of, I don't know, money transmission, and the DOJ has their own rules, and they haven't really told us what they are, other than after they prosecute you, how are you supposed to know what's legal? That's my point about e-commerce. Like, if you were a lawyer advising a client and the DOJ is serious about what they said, I have no idea how you tell that client anything other than get the hell out of the United States as quickly as possible if you want to stay out of jail, right? Because you cannot have a legal standard of, well, we'll tell you after the fact what it is in a criminal prosecution, and all of the guidance that all of our agencies have published, they're wrong. Because, like, something that will maybe resonate with crypto people, This would be a little bit like the DOJ charging you with securities fraud after you had gone to the SEC, presented them something, and the SEC clearly and publicly told you this is definitely not a security. Like, wait, what just happened?
Yeah, it doesn't make sense. It's like I want to start literally a business that does money-related something, and I either want to be an MSB or I don't want to be one. Why don't we go to the agency that determines that, and they'll tell us what is and isn't. I say, okay, I decide I don't want to be one. They've told me specifically if I do these things or don't do these things, I won't be one, and then I get charged criminally with being one.
Right, and
not having registered, even though the registering overseeing agency said I didn't have to register.
Yeah, it would have rejected you. So if you read so Coin Center, as you said, wrote a piece on this, and if you read their piece, interestingly, basically all but roughly one sentence in the thing is opposing this leg of the argument, right? And saying, listen, this cannot be the standard. It has all sorts of very serious problems for the U.S. economy and rule of law. And I largely think they're correct without getting into the exact particulars of their argument. And then they had one line in there that's like, we're not really talking about the conspiracy to commit money laundering part, right? And to me, this is the problem of if our legislators don't pass law and if our regulators don't take their duties seriously and you just sort of punt it to law enforcement and prosecutors are in the game of winning.
Yeah.
They want to find people who are guilty of criminal acts and put them in jail. I would doubt that the DOJ prosecutors are sitting there being like, well, we've got to think really deeply about the long-term implications for U.S. Web 2 fintechs. They're like, no, these guys are crooks. Let's put them in jail.
Yeah.
And this is sort of the breakdown of law when we haven't been able to clarify things in this space.
Yeah, it seems like they're, to your point about trying to make this case, that they're sort of saying, well, we think we could convince a jury that, money went in and money came out, and if it weren't for Samurai Wallet in this instance, it wouldn't have. So doesn't that look like Western Union to you, jury, right? Even though it's just technically and fundamentally not how it works, you could see how you might be able to convince someone that, I don't know, didn't they open up Samurai Wallet? Didn't they put money into Samurai Wallet? Didn't they then later send money out of Samurai Wallet? Isn't that Samurai Wallet that did that? Well, actually, no, not really. It was software that, you could run
also here's
your house.
Here's the extensibility of that argument. So I send you money by going to Chase's website, logging in, sending you through Zelle or something $1,000. So obviously Microsoft Edge is a money transmitter because it couldn't have happened without that.
Right.
I went in and money went in and then came out.
Right.
And that's again
Didn't you type on a box and then money came out?
Right, exactly. Where is the line
Right.
is the question that I have for the DOJ on this one.
And it seemed like it was relatively well defined by FinCEN, but now it's just a problematic situation. It doesn't make a lot of sense. By the way, you still do owe me that $1,000. Yeah, I hope we can solve some of these, something like that with DOJ. I mean, maybe with a different administration that can send, I don't know what they're called, but a directive down to the U.S. attorneys saying this is the way we're going to interpret law in this area going forward. That could change it, but that doesn't have lasting effect. Seems like legislation is the real way because we're talking about a legal argument. We're not talking about a regulatory oversight. As far as we know, the regulatory guidance from FinCEN remains intact. It's more about constraining what the law enforcement and prosecutorial authorities can do with the law.
Yeah, and that kind of brings us full circle to the first discussion of this has been a really hard space for people to make laws. And I want to be clear, I'm sympathetic to that. So if you put yourself in the shoes of congressional staff, they're doing 500 things, right?
Yeah.
They're underpaid, overworked, and they are never experts in the stuff they're working on to the degree of all the people squawking in their ears.
Yeah.
And that's hard in a normal situation. And then you get to crypto, where the span of people squawking are everywhere from people basically saying state-sponsored money should be illegal and shouldn't exist, all the way to people saying China doesn't surveil nearly enough. And they're hearing all of that. And it's hard for them to differentiate. And by the way, in their boss's layers of concerns, this is maybe 57 out of 100, right? Because number one and number two are things like inflation and immigration and
policy.
Israel and the Ukraine. Crypto is not a top thing for the overwhelming majority of people. And so this job is impossible in their shoes, but the only way out in the long run is going to be with good legislation. And to some extent, also good rule of law by judges. Because your ideal situation in Samurai is a judge slaps that second leg right out of the courtroom and be like, just looks at this and is like, this is not what it says. Goodbye.
Yeah. That makes a lot of sense. Okay, before we wrap, though, Austin, you are a professor at Columbia Business School. I know some folks there. Our friend Omid Malekhan, who's also been on this show, is also a professor there in the blockchain space. I'm always interested to know what – I'm not going to call them kids because business school students may be older than they're not freshmen in undergrad, but what are you guys talking about? What are you covering? Maybe start here. What are you covering in your course or courses this year as it relates to the crypto and blockchain industry?
Yeah, so part of what we've been trying to build as curriculum is sort of a way to give people a comprehensive understanding of the space without hot takes and in a way that they can use to actually go get jobs. Yeah. And so I would say at Columbia right now, Omid teaches the fundamentals of blockchain course. If you want to know what a blockchain is, how it works, how consensus is formed, and these sorts of things, you should definitely take his class, and it's very good. And then I teach after that what I would describe as essentially the blockchain equivalent of the financial markets survey class, which is cool. We built these things. Now what are people doing with them? So now we're covering all of the primitives in the space, like what's an AMM, what's a borrow-lend protocol, what's an oracle, what's a bridge, what's a stablecoin, like how do wallets actually work in practice? With the idea of if you think of business school students, they're going to become, business development people, product managers, maybe they're going into policy. You're not really having core devs coming out of there. And so they need about, a half-mile deep understanding, not a multi-mile deep understanding, but of many, many things. They need to be at least semi-generalists. And so that's the course I teach as background. What are they most interested in? I would tell you stablecoins and payments are a big topic of interest for them. And then all of the things that facilitate transacting on chain in meaningful ways. Because I would say if you are somebody who is over the age of 50, something you need to understand is that people who were growing up and experienced the financial crisis in their formative years, so call it teenagers or younger, maybe even early 20s and college students, are really, really skeptical of the traditional financial system. They don't trust it. They saw it break. They don't think it's good. And the idea that things 30 years forward will look like they do now with a bank oligopoly that controls four things, I just think is not borne out by reality because these people just don't want to do business with those entities. And so it is a lot of people looking at building systems of, I want to take back control of my money. I want to take back control of payments. I want everything to be more transparent and fair.
Gosh, that sounds kind of inspiring. They see a brighter future. They think that public blockchains can help get us there.
I would say yes, and I want to emphasize the public part because one thing that gets absolutely zero attention in my class is all of these private bank chains. Yeah, they are in many ways, I think, a bridge to nowhere. Because all that is the exact same bank that we all already disliked, but with a different back end. Right back to our discussion of just changing the ledger.
Yeah.
Yeah. And so I would say it's public blockchains. And an important point of that, and I think this is a point where regulators and policymakers have been behind the curve, that doesn't mean completely permissionless Bitcoin-like implementations. In many cases, people are fine with permissioning on public blockchains. Like if I have a token that represents, say, my house, there should probably be some ability of somebody to say freeze or seize that token because it shouldn't be the case that if North Korea hacks a service, I can't live in my house anymore because they stole the NFT. I get it. But on the other hand, that also doesn't mean that we need an impenetrably dense black box that nobody knows how it works that records ownership of my house either. There are many things that range from public and permissionless to call it semi-public and permissioned that transform these into more communal goods than private monopolies and oligopolies. And I think that is largely what many of my students care about.
Super interesting. And I love that quote, private blockchains are a bridge to nowhere. It's like a double or triple entendre right there, Austin, my friend. Austin Campbell from Columbia Business School. Thank you so much for coming back to Galaxy Brains, Austin.
Yeah, it's great to see you. I'll be back in roughly 1 year when stablecoins become relevant again.
That's it for this week's episode of Galaxy Brains. Thanks to our guest, Austin Campbell from Columbia Business School, and my friend Bimet Abibi from Galaxy Trading. All right, here it is. It is my speech at the National Press Club from April 9th at the Bitcoin Policy Institute Summit in its entirety. Here it is, and we'll see you next week. When our founding fathers threw off the yoke of foreign tyranny, they did so largely as a reaction to encroaching intermediation. Restrictions on transactions and oppressive taxation, even on the simple creation of official records, were such an affront to liberty that they resulted in the American Revolution. How could a faraway power charge the affixation of stamps to official documents, preventing local parties from conducting simple transactions? Soon after the taxation and document restrictions came physical restrictions, checkpoints, barricades, and occupation. Indeed, the right to transact freely is coupled with the right to assemble, to incorporate, to prosper, and to speak. America is a nation built on the values of individual liberty and human rights, strong property rights, and openness. While we haven't always lived up to the best of our ideals, and we don't always, America's values are human values, and we achieve our greatest successes when we strive to live up to the best of our beliefs. We believe in the freedom to transact. We believe that protecting the fruits of one's own labor and being able to execute transactions with another willing party is core to capitalism, free trade, American values, and indeed the human spirit. It is impossible to imagine a future where humanity is supremely successful, but in which two humans cannot transact directly with one another without an intermediary. This freedom has always existed, but until recently it had not expanded into the digital realm. To be sure, a passerby could purchase something from a yard sale directly with cash, you know, the wrinkled and cotton-based paper you might have in your wallet. You probably don't have any. But no digital means to exercise that inherent freedom to transact directly without an intermediary existed. That is not until Bitcoin. Sure, we have digital dollars today, we have fintech apps, but most digital systems we possess today are nothing more than window dressing atop the existing centralized intermediaries, a slick UX serving as a veneer over the legacy system. The gatekeepers have persisted, and gatekeep they have. In almost every country on earth, from liberal democracies to totalitarian dictatorships, those gatekeepers have blocked, frozen, even stolen the funds of citizens, even those who have broken no local laws. And they've relegated that freedom to transact to a mere suggestion, one that can be taken away without even a court order. Our once free and open system is today a web of interlocking, rent-seeking intermediaries and gatekeepers, all with a behemoth government surveillance apparatus strapped on top. Bank Secrecy Act reporting thresholds were set in the 1970s and haven't been updated for inflation. The $10,000 suspicious activity report and currency transaction report threshold set then is the equivalent of $2,000 today. The threshold has remained the same despite significant declines in dollar purchasing power, effectively expanding the surveillance state. Nobody voted for this. Soon the purchase of a consumer electronics good could require the filing of a SAR. Government has deputized banks and technology companies as a means to surveil and restrict the innate human freedom to transact. And now some want to deputize software developers, computation data centers, and indeed everyday Americans who choose to run Bitcoin software in their own homes. This is not good for Bitcoin, our economy, or for America. Why did our core human freedoms not transpose to new global communications, economic, and technological networks? For what reason did the technological expansion of the last 75 years mean that humans could not continue to transact directly with one another as they have for millennia? The reality is that each technological advancement presents new opportunities, opportunities for both liberty and enslavement, for justice and travesty, for majesty and manipulation. There will always be forces who seek to pervert the tools of the future to perpetuate the injustices of the past. Our challenge as humans and Americans is to build and grow society while not only maintaining but expanding human freedom. Bitcoin is a tool for expanding human freedom. You will hear today about how Bitcoin supports human rights and liberty across the world, from activists who fund their operations to refugees who protect their wealth. You might ask whether the freedom to transact has negative repercussions. Some might remember the quote from Ben Franklin, quite famously, "Those who would give up essential liberty to obtain a little temporary safety deserve neither liberty nor safety." But the reality is that Bitcoin is a terrible ledger for crime. Its transactions are transparent. Its ledger is permanent. Law enforcement, forensic investigators will tell you that Bitcoin is easier to trace than traditional fiat, and that its use for illicit activity has mostly declined in both real and relative terms over time. But Bitcoin has other features that make it widely adopted around the world. In addition to transactional freedom, Bitcoin is also provably and predictably scarce. It's well known as digital gold, scarce enough to hold its value, but available enough to be good money. In fact, Bitcoin was the first instantiation of digital scarcity in human history. It literally undoes copy and paste on the computer, which is why it has succeeded as the first natively digital money. Just as scarcity drives value across commodities and other goods, scarcity is also core to Bitcoin's value. It stands in stark contrast to the supreme abundance of the United States dollar and other fiat currencies. Proximity to that money printer has helped the United States expand its influence around the world, but that expansion has come at a heavy price: crippling debt. It is no secret that the US government is doing a dismal job at managing its finances. Just during this speech alone, the US government will have added $200 million to the national debt, $1.50 per US household every 30 minutes, $10 billion a day, $1 trillion every 100 days. That debt is unsustainable, and everybody knows it. We are on a path that leads to one of two places: huge spending cuts and tax increases, or crippling inflation. This used to be the iconic swan song of doomsaying gold bugs, but I promise you, markets have figured it out. It took time, but it's now the mainstream investing consensus on Wall Street. Real rates as a measure of nominal interest rates minus the inflation rate have diverged significantly from the gold price. Demand for gold is rising worldwide, while demand for US government debt is declining. For years, gold and US treasuries served as hedges and traded with a high positive correlation. Today, that correlation is deeply negative. The world is literally stockpiling gold while reducing its exposure to US debt. Why could that be? This should worry every American and every American policymaker. This is American interest, power, and influence declining before our eyes. Now, if that worries you, and if you think that Bitcoin further undermines American interests, power, and influence, the best insurance is to own Bitcoin and to support the growth of the Bitcoin industry in America. We are already the global leader in Bitcoin ownership, entrepreneurship, mining, technology, and intellect. The US government is the largest holder of Bitcoin. There's no surprise that America is the global Bitcoin leader. We have the deepest and best capital markets, the strongest property rights, the most legally codified human rights, and our values align with the open, permissionless nature of the Bitcoin protocol. Bitcoin brings jobs, growth, prosperity, and liberty, and this is a lead we should not squander. Contrary to what some critics will tell you, Bitcoin and America can succeed together. While it is true that as a fixed supply commodity money, Bitcoin's value is impacted by the imprudence of our monetary and fiscal policies, it is also true, as I've argued, that Bitcoin is an expression of American values and power, not just a hedge against their dominance. Bitcoin doesn't just hedge against American dominance and influence, it enhances it. Bitcoin is innovation, it is liberty, it is power, and it is hope. We can grow our economy, bring and keep jobs in America, and expand our international and geopolitical influence by embracing the gold of the future. And the good news is, to accomplish that, we don't really have to do anything. It's more about what we shouldn't do. We're already the global leader, we need just not squander it. And make no mistake, if we make it impossible for Bitcoin to thrive in America, we won't be banning Bitcoin. We'll be banning America from Bitcoin, because Bitcoin is here to stay. That's the reality. If the United States doesn't press its advantage, other nations will, and other nations are. And those nations might be ones who do not see the world the way that we do, and who choose to build a different future that is much more damaging to our values than an American Bitcoin industry ever could be. The future is digital, and the United States has pole position to ensure that the internet's digital native money has a safe and vibrant American foundation. If we drop this ball, somebody else will pick it up, and we might not like the way they play the game. Thank you. Thanks for listening to Galaxy Brains, the weekly podcast from Galaxy Research. If you enjoy the show, please like, rate, review, and subscribe wherever you get your podcasts. To follow Galaxy Research, sign up for our weekly newsletter at gdr.email, read our content at galaxy.com/research, and follow us on Twitter at GLXY Research. See you next week.